Hi, everyone. My name is Szul, and I'm CEO and co-founder of Rome Blockchain Labs. And Rome Blockchain Labs exists to bring people around the world an opportunity to experience abundance in the financial sector, primarily through blockchain technology. Today, we're going to be talking about decentralized liquidity protocols, also called lending markets, as one of the facets that's determining the evolution and, in some sense, revolution of the financial sector. So, getting started, what exactly is a decentralized lending protocol or a money market? Simply put, decentralized lending protocols are non custodial money markets which provide depositors access to variable rate generating and borrowing products. Now, that's a bit of a mouthful. So, to put it very, very simply, a lending market or money market allows individuals to deposit capital into a protocol that will then be lent out or borrowed by other depositors. And the people who borrow the capital pay interest on that loan. And then when they repay that loan back into the market, the individual who deposited gets the majority of that capital back. So if I could get some thumbs up or some hand waves that made sense, I'd love to make sure that I got everybody on the same page here. Perfect. Perfect. Thank you. So essentially, what we're doing at Rome Blockchain Labs is bringing in that next phase of finance by allowing this lending and borrowing. I don't want to quite call it banking because it's not, but this process of moving capital around efficiently to everyone around the world. Stonks and diamond hands is very common in this space, exactly. So before we get into more detail about lending markets, let's look at what's required in the modern day lending and borrowing space. Now, in order to borrow money presently, you need to open up a bank account, which requires your personal identification. You typically need to show a proof of employment for a loan. You have to supply information on your other outstanding debts and expenses. And then they also want to look at your borrowing and financial health. So they want to have a down payment. They want to evaluate your DTI, your debt to income ratio. They often go through a credit check, and you're kind of stuck with that loan until it's repaid or you either claim bankruptcy on that. And typically for loans, if you repay too early, there's a fee because the lending institution, so the bank, the commercial bank, the credit union that you're working with, doesn't make too much money if you pay back your loan too quickly. So with this in mind, how exactly does blockchain technology and DeFi or decentralized finance interact in this framework that we're all used to? And I will pull it up here. Perfect. So in order to establish a bank account on a blockchain or to interact with these lending markets, you don't supply your personal identification. You actually just supply a public key or crypto wallet address, which is a wallet address that's publicly viewable and kind of represents your bank account. Instead of proof of employment, the smart contract looks for proof of funds on a ledger. So they look in your wallet to see, okay, does Alice or Bob have the Bitcoin or Ethereum or USDC or Tether necessary to interact with the protocol? And then instead of looking at your debts and expenses, all of your financial information for that wallet is public but anonymous on the blockchain in and of itself. Instead of a down payment, you have collateral, which is pretty much the same thing. Instead of DTIs, you actually have the smart contracts that manage all of the deposits on chain. So there really isn't off-chain debt for on-chain services in the way that you have with kind of real-world finance, where you can have outstanding contracts and debts and agreements with several institutions all at the same time. Instead of credit checks, because the blockchain is anonymous and there's no way of really knowing who's interacting with it, everything is over collateralized rather than under collateralized. And we'll talk a bit about over collateralization in a bit. And then last but not least, on lending markets and money markets, the loan is repayable within one block on the blockchain, which for Ethereum is about 6 seconds. So rather than a 30-year or a 15-year loan, you can get a 6-second loan, which is pretty fun. There's a lot of interesting things that you can do with this technology. So I'd like us to step into the risk side of these markets. So there's two general breakdowns of risk that every financial protocol, whether on a blockchain or not, has to deal with. And it's that personal or account level risk, and then that grows into a congregation or collection of systemic risk factors. So DeFi lending services address this risk with two general principles. You have the DLT, or the distributed ledger technology, the blockchain, and then you have the smart contracts or the programs that sit on top of that blockchain, and and then facilitate the conditional exchange of that currency. So Alice exchanges this with Bob, Bob lends this out to Charlie, so on and so forth. And with these two financial and technological systems, you can cover all personal risk. But what happens when you have several individuals, be they hundreds or thousands or tens of thousands of individuals, all depositing and borrowing from these markets? Well, you have systemic risk, which is actually covered by automated loan underwriting and liquidations. And we are going to get into more details about this in the future slides. The reason I brought this up is to understand that the technology that's coming out on blockchain networks, be they lending markets or decentralized exchanges or even derivatives platforms, actually cover the full scope of technologies and considerations you have with your traditional finance or TradFi systems, but in a way that's more efficient because there's no intermediary and it's pretty much automatic 24/7 markets. So let's go into the topic of over-collateralization. If we walk through what a traditional bank does, it's an under-collateralized loan. So let's say, for example, that Alice wants a loan for $5,000, right, to open up a new company that she's starting to get that initial capital. The bank might require a 10% down payment on that position. So Alice walks in, goes through the whole background check, the credit check, the financial analysis, gives the bank $500, and the bank says, "Here you go, thank you very much. Here's your $5,000 back." Now, decentralized protocols can't do that because Alice doesn't really exist on chain. Alice is, for all intents and purposes, just a cryptocurrency wallet with the crypto in the wallet. So if Alice goes and puts $500 worth of Bitcoin in and wants to go and borrow $5,000 worth of Ethereum out, we can't quite trust that Alice is going to pay that back. So the way that these protocols overcome this is by doing an over-collateralized deposition, where let's say Bob wants a loan for $5,000, then he'll have to deposit perhaps 200% or $10,000 of capital into that market. So he puts the $10,000 in, then he can borrow $5,000 from a different pool or from the same asset in and of itself. And this is required, like I said, because of the anonymous nature of the ecosystems. And it's important to note that this inflection point of deposit ratios isn't actually a hindrance to sustainable capital accumulation, but is actually quite advantageous to it. If you think back to the 2008 recession and the 2007 and earlier activities, primarily facilitated by hedge funds and some larger banking institutions, that led to drastic leverage on trading positions, mostly using derivatives. There was, we're talking 13, 30, even 50x leverage on loans that were given out, on margin positions, I should say, that facilitated a gigantic bubble under the assumption that the underlying assets would never fail, that everyone's going to pay their mortgage, and we should be able to pretty much print money for as long as everybody's living in a house. And as we're all aware, that actually isn't how that panned out. So all of a sudden, when it became impossible for a lot of these large funds to repay back their lenders, and the lenders were unable to repay their own depositors, you had a gigantic financial crisis, a banking crisis on your hands. I won't go into the 2008 collapse, but suffice it to say that in the decentralized finance space at present, because everything is over collateralized, as long as there's no existential hacks like the smart contract risk or anything, then everything stays solvent. Everything is liquid because there's always more than enough money to cover the loans. So how exactly does this process work? And I'm going to see if I can zoom in. It's difficult to zoom in on this one, but we'll carry through from the left to the right. So essentially, we have Alice on the left who connects her crypto wallet and at the bottom deposits her funds into the lending protocol smart contract. Can you guys see me click here? Oh, perfect. Okay, so I'll just click on this screen. So Alice connects her wallet here and then deposits her cryptocurrency into the smart contracts on the blockchain. So smart contracts are simply packets of code that control how the money is moved. And then from there, the funds are deposited and then they're lent out to other depositors. So for example, Charlie right here. So Charlie has also deposited capital, and then he's going to go ahead and use that in another area of the decentralized finance ecosystem. And then after he's gone through and made his money, he's made a profit, he's going to pay off his interest. He comes back to the protocol and then fully repays his loan plus the interest that's accumulated. Those those funds go back into the smart contract, and then Alice is returned her initial deposit plus a portion of the interest that's repaid by Charlie. So at a high level, does this process make sense? Can I get some more thumbs up or emojis? Wonderful, wonderful. Thank you. So even though blockchain and decentralized finance can sound like a complex concept and it might seem way over a lot of people's heads if not technical, it's actually very easy to understand once you break it down into very simple processes. So the question arises, right? If we go and think about Charlie for a second, who took some of Alice's money from the market, who's also a depositor, what happens if there's, for example, a mass withdrawal of funds? What happens if Charlie and everybody else, or sorry, if Alice and everybody else who had lent out their money all of a sudden wants it back? Well, in traditional banking, you typically have unpaid depositors because there's fractional reserve and zero reserve banking, which I think most people here should understand. But essentially, if you go to your local bank branch, they don't actually have your money there. There's no cash that you can pull out. It's all managed electronically, and often most of that capital is also lent out in CDs and through other vehicles to other people the bank works with. In decentralized lending, because everything is over collateralized, everybody can withdraw their money, assuming that you didn't borrow anything against it. If you borrowed it, then your collateral has to stay in. But if you didn't borrow, you can always pull it out. The other question comes in is that if you think about Bitcoin and Ethereum, they're pretty volatile assets. So what happens if the value of my Bitcoin that's backing my loan, so Bitcoin is up here, I'm borrowing against it to pull out something else. What happens if this goes down? Well, in traditional banking, we all work in dollars, so that really isn't going to matter too much. And I won't really get into Forex. But in TradFi, your individual borrowers are comparatively unaffected. In decentralized lending, the markets actually algorithmically will liquidate positions to maintain stability, which is something that we'll talk about later on. And of course, most importantly, what happens if there's a bank failure or a bug or a smart contract exploit? Well, in traditional finance, your FDIC insurance covers up to $250,000 for retail depositors. In decentralized lending, there's optional crypto insurance, but beyond that, you're really up to the reserves or the security or the capital in reserve that these markets have to cover potential shortfalls. So we spoke a bit about how to manage a position in the event that somebody doesn't repay back their loan or if that collateral shifts. The thing that lending markets always have to monitor on the risk side is market stability. So let's go ahead and walk through this example. And if you guys can understand the example with Alice and Charlie, if you understand liquidations and you are ready to run one of these markets yourself. So a position or a borrower has two things that they look at. They look at their deposit. So in this case, let's just say that Charlie has deposited $15,000 worth of Bitcoin into the market. And that deposit allows a certain amount of capital to be borrowed. He can't borrow 15,000. He can borrow up to a certain amount. And he takes out a loan for $5,000 worth of USDC or of Ethereum, okay? Let's say over time, the markets kind of go down, the value of his Bitcoin collapses. All of a sudden, the market has hit his liquidation threshold. The algorithm has said, hey, your margin isn't high enough. We're going to have to go ahead and liquidate you. So what happens is that a third-party actor will step in. And what they do is they will actually purchase a portion of the deposit or the collateral, and then they'll sell it for a profit on the open market. So it'll be sold at a discount, purchased for a profit, sold on the open market, and then a majority of those proceeds, minus the fees kept by the liquidator, will go to repay back the loan that Charlie owes. So basically, the market says we're going to take a portion of this collateral, we're going to sell it at a discount, take away, not too much of a discount, but sell a discount, take some of that money, pay off your loan, and now everything is sandwiched down, and we're back at a healthy ratio. And if the collateral goes down again or the interest rates go up, the same thing happens. It'll liquidate a portion of this, send it, and then pay off of this. And that'll happen recursively until the entire position is taken care of. So a little involved, but it is kind of straightforward. Basically, your deposits are just used to pay off your loans in the event that you don't pay them back. So does that make sense? Thumbs up. Perfect. So to kind of wrap this up and then move over to the Q&A section, I see Adam has a couple questions. I'm sure there's some other ones here as well. is that what are some of the benefits about working with a liquidity market, and how is this technology, as it's emerging, looking to change the way things work? Well, most importantly, it provides access to cost-effective capital that's secure, low credit, to low credit and unbanked individuals. You also can eliminate high-risk over-leveraged positions and poorly collateralized financial instruments like derivatives that will actually eliminate any chance of insolvency, assuming proper market operations for these type of protocols. So the kind of wide-scale bank systemic risk we saw in 2008 can't theoretically happen with this type of technology. So not to say that's completely impervious to it, but there's a lot more liquidity there to maintain that. You also, if you'll notice, see that every single thing is done on the blockchain. There's no clerk, there's no underwriter, there's no risk auditor, there's no other person inside this market between Alice and Charlie approving and checking off every single thing that goes on. Instead, there's a very smooth, mathematically and algorithmically backed trading process that maintains all of the markets at all times. So you have actually increased efficiency while with decreased overhead. So you're not paying for a huge staff to maintain these platforms. The downside is that you do have some variability in the returns, but the returns on at least stable coins is quite good. If you think of your traditional bank, they're going to give you what, 0.1%, maybe 0.5%. If you go to some smaller banks, you might get 3, 4, 5% on your deposits. For DeFi lending protocols, you get anywhere between 0.5% or 2% on the low end, up to over 10%, depending upon market demand. So the return rates on these positions, at least on the dollar stable coins, are comparatively good. You also have the provision of liquidity to decentralized exchanges. I won't go into that side because that's a bit too far in the DeFi for our high-level talk. But most importantly, you have guaranteed solvency across several multi-billion-dollar money markets, which is something that helps you rest well at night. So thank you very much for this time and opportunity. I love talking with you guys. I love the emoji interactions, by the way. If you have any questions about lending markets, decentralized finance, blockchain technology, or you're interested in going into that space and not quite certain what steps you should take, send me an email or shoot my company email at contact@roamblockchain.com. We'll be happy to talk.